$408 billion. That is the massive current market capitalization of the Royal Bank of Canada in Canadian dollars. And it's been fueled by a staggering 26% stock rise so far this year alone. Now, that kind of explosive growth for an established legacy financial institution is, quite frankly, nothing short of phenomenal. But it brings up a really huge question. How exactly is a traditional bank generating that kind of momentum in 2026? What are the actual stakes here, and what is powering this absolute massive valuation?
Well, welcome to today's Explainer. Today, we're focusing squarely on RBC, an institution that serves over 19 million clients globally. But listen, we aren't just looking at your standard traditional banking story here. We are looking at a bona fide innovation engine. Our core theme today is exploring exactly how RBC is taking its massive traditional banking wins and strategically using them to fuel a wildly ambitious tech-forward future.
Okay, let's dive into this. To really grasp this corporate transformation, we're going to unpack RBC's strategy across 5 distinct pillars today. First, we'll look at their record profits and dividends. Second, the billion-dollar Moneris sale. Third, how they're leading the AI revolution. Fourth, recent regulatory shifts and fines. And finally, we'll look at what comes next.
Starting right off with Section 1, record profits and dividends.
To truly understand their massive tech ambitions, we absolutely have to look at the financial engine that's actually making it all possible. Their Q2 numbers from May 2026 are the bedrock of this entire story. Just look at the leaps in net income year over year across their divisions. Capital markets up 23%, wealth management climbing 28%, and commercial banking soaring by a massive 43%. This right here perfectly illustrates a diversified bank that is quite literally firing on all cylinders. In fact, CEO Dave McKay credited this exact diversified business model for their overwhelming success this year.
And when you add all of those divisions together, the sheer scale is staggering, $5.5 billion in earnings. That makes it RBC's second highest quarterly performance on record. The fundamentals backing us up are just rock solid. They delivered a 17.2% return on equity, and because of this massive profit, RBC was actually able to bump its quarterly dividend up by 7%, bringing it to $1.76 per share. This is the financial muscle they are flexing right now.
Which brings us to Section 2, the Moneris billion-dollar sale.
You know, making money from your core business is one thing, but strategically monetizing non-core assets to add to your capital war chest, that is another level entirely. Take Moneris. They own a massive 33% slice of the Canadian transaction market. To put that into perspective, 1 in every 3 transactions in Canada passes through this exact system. If you live in Canada, 1/3 of your daily purchases are likely processed by Moneris, a system that serves 325,000 businesses. It was originally founded 25 years ago as a joint venture between RBC and BMO. But then, on August 10, 2026, they announced they were selling it to the San Francisco-based investment firm Francisco Partners for incredible $2 billion Canadian dollars. And since RBC owns half, they expect to pocket a very comfortable $475 million in after-tax gains. The big takeaway here, RBC gets to cash in on this asset's success, instantly adding nearly $500 million to their balance sheet. And here is the absolute kicker. They aren't even walking away completely. They're keeping exclusive long-term referral ties with Moneris. It's honestly a masterclass in balance sheet simplification.
Moving on to Section 3, leading the AI revolution.
So what exactly is a traditional bank doing with all of that capital? Well, they're using it to completely dominate the AI landscape. Chris Phillips, RBC's Senior VP of Global Functions Technology, noted that while credit underwriting is highly rule-bound, bringing in AI proves that even deeply embedded processes can be completely reimagined. And this isn't just fluffy corporate speak. On August 13, 2026, RBC actually won an IDC CIO award in Canada specifically for their AI-driven retail credit underwriting program, which has improved approval rates and delivered much faster decisions for clients.
And the depth of this internal commitment is just jaw-dropping. RBC is currently ranked #1 in Canada and #3 globally among financial institutions for AI maturity. They have nearly 27,000 employees actively using their internal tool RBC Assist. Over in capital markets, 8,000 employees are using an AI tool called Aiden. Plus, their proprietary ADOM foundation model is already deployed across 15 different products and processes. This kind of widespread adoption doesn't happen overnight. It's the result of a decade-long investment that started way back in 2016 with the establishment of the Borealis AI Research Institute.
The financial stakes tied to this tech push are absolutely immense. RBC has set a massive target for themselves, generating $700 million to $1 billion in enterprise value from AI benefits by 2027. And to make absolutely sure they hit this goal, they've recently established a dedicated AI group reporting directly to the CEO, led by veteran tech executive Bruce Ross, their newly appointed group head of AI.
This all clicks together perfectly when you listen to CEO Dave McKay. He recently stated that the push for AI compute capacity is driving an insatiable appetite for all forms of capital. This connects all the dots of our explainer so far. This AI build-out requires an insatiable amount of capital. And as we saw in the first two sections, RBC's record earnings and that $2 billion Moneris sale are exactly what provide the bank with the balance sheet capacity to feed that appetite.
Let's look at Section 4, Regulatory Breaks and Fines.
Of course, running a massive, multi-billion-dollar operation means facing some very strict rules. On one hand, we have a huge structural advantage. Canada's banking regulator recently reduced the domestic stability buffer, which is essentially the emergency cash safety net banks have to hold, down to 3%. This is highly significant because it frees up literally hundreds of billions of dollars in lending capacity across the major banks, really fueling RBC's ability to deploy capital exactly when they need it most. But on the other hand, we have a compliance hurdle. The FCAC fined RBC $4.25 million. This was a penalty for historical credit card statement errors spanning from 2001 to 2024, stemming from inadequate oversight procedures when transferring credits on canceled cards. Now, RBC self-reported this past operational failure, a glitch older than some of their junior analysts, really, and they've already paid $22.4 million in refunds to the impacted customers, alongside paying the fine itself.
Finally, Section 5. What comes next? With a newly reinforced war chest and an evolving regulatory landscape, what should investors be watching for next? Well, just look at the sheer momentum in August 2026 alone. On the 10th, the massive Moneris sale was announced. Just 3 days later, on the 13th, they secured that prestigious IDC CIO AI award. On the 24th, shareholders will see that increased $1.76 dividend hit their accounts. And that leads us right up to August 27th, their highly anticipated Q3 earnings call.
And here is the crucial question to keep in mind. Will the provision for credit losses, or PCL, ratio continue its downward trend? In the second quarter, it actually fell to just 0.35%. That is the real-world metric everyone will be actively watching on the morning of August 27th, just to see if the bank's risk profile remains as impressively strong as its profit margins.
So to wrap up today's explainer, RBC has definitively proven it's far more than just a legacy bank. Through record $5.5 billion Q2 earnings and unlocking capital via the $2 billion Moneris sale, they've built the immense capacity needed to feed an insatiable capital demand. They're leveraging that capital to target up to $1 billion in AI value, radically changing how they operate internally and serve clients externally, all while navigating ongoing regulatory shifts. Ultimately, RBC is successfully maneuvering its massive capital to completely future-proof itself. But it leaves us with one really provocative question to think about. If a traditional bank is investing this heavily in becoming an AI powerhouse today, what exactly will a bank even look like a decade from now? Thanks for learning with me today, and I'll catch you on the next explainer.